Module 2. Traditional funding sources: banks, venture capital, angel investors, and private equity. 1. Bank financing. Bank loans are the most conventional form of debt capital, widely used by businesses of all sizes. This section examines types of bank financing: term loans, overdrafts, revolving credit lines, and project-specific loans. Evaluation criteria. Banks assess creditworthiness, collateral, cash flow projections, and business viability before lending. Interest and repayment. Loans typically carry fixed or floating interest rates and require repayment in installments over an agreed term. Advantages: predictable cash flow management, no dilution of ownership, established legal framework. Challenges: strict documentation requirements, collateral demands, risk of over-leverage, and potential covenant restrictions. The module emphasizes preparing bank-ready financial statements, cash flow projections, and business plans to improve loan approval chances. 2. Angel investors. Angel investors are high net worth individuals who provide early-stage funding in exchange for equity or convertible instruments. Key aspects include role. Angels often invest at the conceptual or seed stage, providing both capital and mentorship. Motivations: profit potential, involvement in innovative ventures, and personal interest in the business sector. Investment size: typically smaller than venture capital rounds, ranging from tens of thousands to a few $100,000. Advantages: early stage support, flexible terms, advisory guidance, and industry connections. Challenges: equity dilution, potential influence on strategic decisions, and informal investment processes requiring careful legal agreements. The module highlights strategies for identifying, pitching, and negotiating with angel investors, emphasizing relationship building and credibility. 3. Venture capital, VC. Venture capital provides professional funding for high-growth startups with scalable business models. This section covers fund structure. Venture capital firms pool resources from institutional investors and high-net-worth individuals. Stages of investment: seed, Series A, Series B, and later rounds. Each stage corresponds to a business life cycle, growth potential, and risk profile. Evaluation criteria: market potential, revenue projections, scalability, competitive advantage, team capability, and exit strategy. Advantages: large capital infusion, strategic guidance, operational support, and access to networks. Challenges: significant equity dilution, stringent performance expectations, and governance involvement through board seats or voting rights. Module 2 emphasizes developing compelling VC pitch decks, understanding term sheets, and structuring exit strategies to maximize returns. 4. Private equity, PE. Private equity focuses on investments in mature businesses seeking expansion, buyouts, or operational restructuring. Key considerations: investment horizon. PE firms typically hold investments for 3 to 7 years, aiming for significant value creation before exit. Mechanisms: buyouts, growth capital, recapitalizations, or turnaround financing. Evaluation metrics: EBITDA, cash flow stability, market position, operational efficiency, and strategic alignment. Advantages: access to large capital, operational and strategic expertise, long-term value creation. Challenges: loss of partial control, intensive due diligence, and high expectations for profitability and growth. This section explores deal structuring, term negotiation, governance, and performance tracking for private equity-backed companies. 5. Comparative analysis of traditional funding sources. Module 2 provides a holistic comparison of banks, angels, venture capital, and private equity based on stage of business life cycle suitability, investment size and flexibility, equity versus debt implications, risk exposure for both entrepreneur and investor, operational and governance involvement. This comparison equips you to strategically select funding sources aligned with business goals, growth stage, and risk tolerance. 6. Key strategic considerations: Successful access to traditional funding requires mastery of financial presentation, negotiation, and investor psychology. Financial statements, accurate, transparent, and audited accounts improve credibility. Business plans. Detailed, data-driven, and market-oriented plans demonstrate potential ROI. Pitching techniques, tailored narratives, clear value propositions, and financial clarity attract investors. Due diligence. Preparedness, anticipating questions, providing documentation, and addressing risk concerns fosters trust. The module emphasizes that raising traditional capital is as much about relationships and credibility as it is about financial metrics.